We do these long-term projections as part of our Fiscal Risks and Sustainability reports. The last one we did showed that long-term trends in things like demographics and also a rising debt burden mean that our current level of debt, which is around 100% of GDP, rises to reach 270% of GDP by the time we get to 2070, so in 50 years' time. That's a level of debt in the UK that we've never seen in our history.
Hello, and welcome to the IFS Zooms In. I'm Helen Miller, Director of the Institute for Fiscal Studies. And today we're talking about fiscal risks. I think the public debates about public finances are in an unhealthy cycle of focusing almost entirely on the next fiscal event. At the moment, that means focusing on the autumn budget and whether the Chancellor will raise taxes. But more broadly, I think the public debate gets too hung up on fiscal headroom and what will happen in the next 6 months. And as a result, we're in danger of losing sight of the wood for the trees. So today, I want us to step back, raise our visions, and talk about what really matters when we're thinking about the public finances. We'll look at the overall health of the finances and the risks that are sitting on the horizon. And it's the perfect time to be doing that because the Office for Budget Responsibility, so the official watchdog, has recently published their annual assessment of fiscal risks. And I think it's fair to say it's a pretty uncomfortable read. I mean, bluntly, if you're sitting there thinking that the only or even the main problem or challenge is how the Chancellor could raise a few tens of billions of pounds in the autumn, then you ain't seen nothing yet. So buckle up. To wade through these risks, I'm joined by the perfect guests. I'm delighted to be joined by Richard Hughes, who is chair of the OBR, and by our very own Ben Zaranko, who is an associate director at the IFS. So Ben, Richard, welcome to both of you.
Thanks, very nice to be here.
Thank you. So, Richard, let's start by making sure that everyone's kind of on the same page with what we're talking about here. The purpose of the OBR's report is to examine the sustainability of the public finances. And what does it mean for them to be sustained? What are we trying to sustain?
So fiscal sustainability refers to a government's ability to maintain its current configuration of tax and spending policies into the future without risking its financial stability by, for example, defaulting on its debts or placing an undue burden of debt onto future generations.
And big picture is the headline. Are we currently in a sustainable position?
So we do these long-term projections as part of our Fiscal Risks and Sustainability reports once every 2 years. The last one we did showed that long-term trends in things like demographics and also a rising debt burden mean that our current level of debt, which is around 100% of GDP, rises to reach 270% of GDP by the time we get to 2070, so in 50 years' time. That's a level of debt in the UK that we've never seen in our history and would certainly put a burden on future generations were they to have to service it, and also probably put at risk government's ability even to continue servicing that level of debt.
And it's worth just dwelling on that a little bit, isn't it? So, just to repeat what you've said in some sense, given that we have an ageing population, for example, and rising costs of healthcare, if we do nothing else, if we just keep policy as it is, debt goes up to, not shy of 300% of GDP, which is, a huge amount of GDP. So it's not a forecast of what's going to happen, because obviously we don't know what policy will do. And in some sense, the fact that that would be probably unsustainable means that something will happen before that. But it's a sense of if nothing else changes, something big will happen to the debt. But Ben, I think you're keen to talk about the fact that there's no magic number for debt here, right? There's not a magic number that we have to stay below.
Right. There's no single number that if we tip above, the sky falls in, and below which everything is fine. And often it's just very difficult to know how much more space the UK has in terms of how much more debt it could take on safely. I think often it's more useful to focus on the trajectory for debt than in the level. And that's why I think the analysis that Richard and his team do at the OBR is so helpful, because even if we can't pin down a precise numerical definition of sustainability, because it depends on so many factors, I think about the definition that the US Supreme Court gave when it was asked to define pornography, and I know it when I see it. And then seeing that chart the OBR produce of debt heading off into the stratosphere, getting higher year on year on year, I think we all know that's not sustainable and something we'll have to give, even if it's subject to lots of assumptions and uncertainties. I think we can clearly say the trajectory we're on as it stands doesn't look like it's consistent with sustainable public finances.
And before we move on with the kind of what's been happening recently, I want to take a little detour into measures of debt, because it's maybe worth saying for people out there that for a long time, the government was targeting one measure of debt, and trying to get that down. And now this current government has a different measure of debt that it's targeting. So, how do we think about that, Richard? Which measure of debt should we care about when we're thinking about sustainability?
I think in the end, you have to look at multiple different measures of the health of the public finances. Sort of like with everything in life, it's hard to reduce a complex question down to a simple number. As you say, the government has moved away from what has been the traditional focus of fiscal policymaking and fiscal rules in the UK in the past, which has been something called public sector net debt, which counts kind of all of the government's debts. And then a few very liquid assets netted off against those, mainly just currency reserves and gold and things like that, things that are very liquid and very easily traded on international markets. The incoming Labour government has expanded the scope of what's covered by one of their fiscal targets to cover something called public sector net financial liabilities. And what that does is basically look at a broader range of financial assets and liabilities that government holds. So on the liability side, not just debt, but also the liabilities of funded public service pension schemes. So their kind of their pension obligations to things like the local government pension scheme on the liability side. And then on the asset side, taken not just very liquid financial assets like currency and gold, but also illiquid financial assets. So things like equity investments, and also where the government itself makes loans to businesses or to energy companies or to other private sector bodies. Those things count as assets on the asset side of the balance sheet. So it expands the scope of what you count toward the government, your measure on the government's balance sheet to include that wider range of assets liabilities. I say it's not the most comprehensive measure of the government's balance sheet. The most comprehensive measure is a thing called public sector net worth, and that takes in all assets of government and all liabilities of government. And that includes not just these financial assets I talked about, but also their non-financial assets. So the fixed assets they own, like military equipment, like the road network, like the rail network. That's the most comprehensive measure that you might have. The government's chosen something a little bit narrower, which just focuses on financial assets which generate a financial return, rather than those wider fixed assets which may or may not generate a flow of funds into future for government, but still serve a public service function, like allowing us to defend ourselves against the outside world, and also to provide things like healthcare and education if you're talking about schools and hospitals.
I think it's worth flagging, isn't it, that I completely agree with you, Richard, that you never want to look at one measure of anything to assess the health of anything, whether it be the public finances or anything else. But just thinking about those different measures, the government spent a long time trying to target the first measure you talked about, the net debt measure, and get that down. And now we're targeting the snuffle, the second measure you described. And it's not necessarily rising on the end of the forecast, but it's not really coming down convincingly. Actually, net debt is kind of rising in the forecast now. So perhaps it's worth looking at, before we go on to the future, about what's happened in recent years. Something that's like, Ben, you and I in our careers have kind of watched governments persistently say, we'll get down the debt in a few years' time. And, Richard's and others' reports has showed that that's not really what's happened. So talk to us about that.
There's a fantastic chart, if anyone wants to look through Richard and his team's report, buried in chapter 3 in one of the boxes, which shows what governments have said on average will happen to debt, which is that it'll go up a little bit and then come back down. And then what's actually happened to debt in the outturn on average, which is that debt goes up year on year on year. I think there's two big things. One is nasty shocks keep coming along. You might plan that you're going to do a nice fiscal tightening, you're going to get things back on a sustainable path gently without any abrupt shocks to the economy. But then something comes along like a financial crisis, like a pandemic, like a global energy price crisis that puts all those plans into the toilet, basically, and you have to revisit. So that's one thing. The second thing is how governments have chosen to behave, which is partly, I think, in response to the design of some of the fiscal rules they've imposed on themselves, is where governments often offer short-term tax cuts or spending increases when it's advantageous to do so, with a promise to tighten things further down the road. But then when that time comes around, they never actually make that tightening. And so then what was the medium term becomes the short term, and there's always an incentive to then provide further short-term giveaways. And that's called, people refer to that as Augustinian behavior, the, oh Lord, make me chaste, but just not yet. And that behavior has played out quite a lot, I think, in the last decade or so. And those things combined mean that debt hasn't gone down in the way that it was forecast to.
So, Richard, reflecting on that, and actually, I should say that I also love the chart that Ben mentioned. So we'll dig that out and post it for people because it's an absolutely cracking chart. But sort of reflecting on that, is it fair to say that kind of the view of the OBR is that things aren't getting any better in recent years in terms of sustainability of the public finances?
Yes, I think that's right. And Ben's exactly right that despite governments aiming to try and get their debt falling over the medium term, it never seems to happen in practice. And governments have been trying to achieve that objective for quite a long time. If you look back since 2000, the debt to GDP ratio has gone up by 66 percentage points, which is quite an extraordinary number just in itself. And when you decompose that into sort of what led that to happen over the last year, we're now 25 years on from the start of the century. When you look at what drove debt from where it was at the start, 30% of GDP up to 95% of GDP, where it is now, about half of that increase in debt that we saw, so about 33 percentage points, happened in the 3 years of the 2008 financial crisis. So 2008, 2009, 2010. And another quarter of it happened, so 16 percentage points happened during the 3 years of the kind of combined COVID plus energy crisis. So you're looking at about 3/4 of the increase in debt just being accounted for, by in essence 6 years of that 25. So about a quarter of that time period explains 3/4 of that increase in debt, and those were just three big shocks which hit the UK economy in relatively quick succession by historical standards. I guess the question that you have to ask yourself is kind of what were we doing for the other 3/4 of the time since 2000, for the other 19 years where we weren't in the midst of just trying to manage the economic and fiscal consequences of these shocks? And the answer is that we basically left debt more or less where it was for a few years, and I'd always promised to get it falling in 4 or 5 years' time. And what tended to happen is that kind of shocks arrived before we got to years 4 and years 5. Or we let years 4 and year 5 kind of drift into the future. And so over that period since 2000, debt has actually never fallen as a share of GDP for more than 2 years in a row. And then even when it did, it never fell by more than 3 percentage points of GDP over any 2-year time frame. So we've never really had a long period of debt reduction in this country since the start of the century. We've had lots of years where it's gone up a lot, but very few years where it's come down by a meaningful amount for a meaningful period.
And of course, in some ways, we're seeing the cost of that now, aren't we? Because we've got a debt interest bill that's now actually pretty high. I think it's outside of the health department, it's the next biggest thing the government spends its money on. So we're spending more money on debt interest rather than on doctors or nurses or whatever it is we might want to spend on. And of course, it also means, we should also remember that other shocks can come along, which is a great way to segue back into the OBR report and the kind of forward looking at the risks. So the report actually picks out 3 risks and does a deep dive, and we'll come back to those. But I first want to talk about my favourite part of the report, which is the Fiscal Risk Register, which is basically a list of, I think, around 50 risks, some new risks like cryptocurrency, some old ones that we've known about for a long time, like aging and climate change. And it is all a bit daunting, but it's a bit addictive. You start reading the list and you kind of can't stop. So I'd really recommend everyone else go read the list too. But big picture, Richard, of all those risks that you've been, looking at in big detail, what are the ones that really keep you awake at night? What are the ones where you think, oh dear, this is really a big one?
Yeah, well, I guess, first of all, thank you for getting all the way to the end where we go through the risk register in detail. I think when we first started doing risk reports in 2017, we tried to sort of do justice to every single one of those 50 risks in every report. And I think what we found is that it just ended up being a bit overwhelming for people to read and for policymakers to really do anything meaningful about. And so what we've tried to do instead is really hone in one report after another on doing a deeper dive into a set of risks which we think are the most meaningful and material for governments to reflect on. As you say, it's sort of daunting. The news tends to be mostly bad. It's sort of in the nature of risk registers in all organizations, whether they're public or private, that you sort of focus on downside risks rather than upside risks, because it's inherently sort of easier to adjust to sudden windfalls than it is to adjust to sudden losses. And for government in particular, because it's sort of insurer of last resort for society as a whole, its risks are probably more tilted toward the downside than a private sector organization. than or a household. In terms of the risks that we look at, one thing that we highlight is this. We try to look at both, what are the sources of shocks to the UK economy, but also what capacity does government actually have to respond to those shocks? And the more shocks that you face, the more that can push up your level of debt, and that just reduces your capacity to deal with future shocks that might come along. There are some ones which kind of all of these reports focus on in almost every country. Demographic change is the one which you see in almost every country's fiscal risks reports and long-term fiscal projections. That's a relatively certain phenomenon, although assumptions about things like fertility rates and life expectancy change, but we all know that our societies are aging. We're all getting old roughly 1 year at a time. So it's a reasonably predictable phenomenon. But it's really important when you do these reports to not just do a central forecast of the trends that you understand well, but also look at kind of risks and shocks that can hit you along the way, which are the kind of known unknowns, as it were. The financial crisis was obviously one of those. The COVID pandemic was another. Russia's invasion of Ukraine was a third. So you've also got to look at how is the outside environment in which economic policy making is being made and the global environment in which the UK operating, how is that changing? And some big things that have changed in the recent past have been in Western Europe and around the world. Geopolitical tensions are rising. We've got a war on the continent of Europe again. There's now upward pressure on defense spending, which is something which we used to think of as being a source of fiscal space within budget, because defense spending was falling from a post-war high of 10% of GDP down to 2% of GDP in recent years. Now the pressure is pushing back upward on that. You've got other things we took for granted, which is global economic integration and rising trade liberalization, making it easier to trade with the rest of the world, helping to support productivity growth in our countries and in others. We now can't take that for granted with the decisions that have been made by the US administration and by others. And also, what we got used to in the period after the financial crisis, falling interest rates, which made the rising debt burdens that the UK government and other advanced economies had easier to afford, despite the fact there was a bigger volume of debt. You're paying much lower interest on it. Now we've got the much tougher situation of a high level of debt and interest rates going back up to the levels that we saw back in 2008, when our debt levels were just half of the debt burdens that we have at the moment.
So lots of reasons to be worried at night. Before we dig into one of these in detail, Ben, do you want to pull any ones out that you are particularly worried about?
I hope we don't face another pandemic or indeed global financial crisis. And I think some of the I think there's interesting ones around that are less. There's nothing we can do about that. If the global financial system implodes, it's probably not our fault. But there are things that are more sort of policy related, where it's some risks to the public finances are as simple as the government said it wants to get defense spending to 3.5% of GDP, but hasn't really thought about how it's going to do that. Or we've created a system for NHS clinical negligence compensation that is a big risk that sits there that could end up with us having to shell out lots of money. Things like the how much we might end up spending on legal fees and so on, and compensation for some of the people affected by the Afghan data leak. These sort of self-created risks, I think, are worth thinking about as well. It's not just about shrugging our shoulders and say, let's hope none of those big shocks come along, because some of this is within government's control.
Right. Okay. So let's go from the high level to dig into one of these risks. And let's start with pensions. That's one of the ones that the OBR looked in a lot of detail. Obviously, you mentioned, Richard, that we've got an aging population that creates all sorts of challenges around people needing more and more expensive health and social care. But it also means we're going to have more pensioners. That will partly mean that there's a higher demand on the state pension. There's also concerns that people aren't saving enough to fund their own retirements. In fact, the IFS recently launched the final report of our big pensions review commission, and that has some ideas about how to stop us getting into that situation. But there are two other pensions issues that you guys picked up that I want to zoom in on. And the first is the triple lock, which regular listeners would have heard us moan about in the past. So Richard, tell us what the triple lock is, and then tell us why it's a kind of risk to public finances.
So the triple lock is the arrangement for the indexation of the state pension, which says that the state pension from year to year goes up by the highest of 2.5% average earnings or the rate of inflation. And when you look at the sustainability of our pension system, which is a big part of the upward pressure that gets put on public spending when you project public spending out over the next 50 years, we have the same problem that every other country has that has an aging society, which is most advanced economies in the world, which is that we have an aging society, we have a baby boom generation that is moving into retirement. And pushing up the what is called the dependency ratio, the ratio of people in retirement claiming a pension to those who are in work and paying the taxes that fund those pensions. And in our sort of central projection, in our long-term projections, life expectancy at 65 is still rising. So it rises from about 21 to 26 years from the age of 65 over the next 50 years. And so both, there being a sort of baby boom bulge of people moving into retirement and people also living longer in retirement, that pushes up the cost of pensions, up and about half of the overall increase in the cost of pensions, which is about 2.7% of GDP in total. About half of that total increase in the cost of pensions over the next 50 years comes from demographic change alone. But the second half of that, which is much more unique to the UK, is the uncertainty created by the operation of the triple lock, which is an equally, if not more important source of fiscal risk around pensions costs going into the future. And that is because when the triple lock was designed and introduced back in 2012, we had certain expectations around the volatility of inflation and earnings, which are two of the determinants of the triple lock, could be two of the determinants of the triple lock in any given year. And higher volatility in inflation and earnings than were expected back in 2010 has meant that the triple lock has just turned out to be a lot more expensive than we thought. It's turned out to be about 3 times more expensive than we thought when it was introduced, and will end up costing around £15 billion by the end of this decade, compared to the £5 billion that we expected when the triple lock was introduced. Because, as people will recall, we've had periods of double-digit inflation, which has pushed up the cost of that element of the triple lock by a lot more than when was expected. So in our report, we also explored the implications of different assumptions around the future behavior of inflation and earnings, and basically ask ourselves the question, well, look, if the future turns out to be as volatile as the recent past has been, how much more could that cost us? And in our central projection for pension spending, that's based on just the long run historical pattern of the behavior of inflation and earnings between 1992 and the present, and that sees the state pension rise from around 5 to 7.7% of GDP over the next 50 years. But were the future behavior of inflation and earnings to look more like the more volatile period that we've seen from 2010 onwards, state pension spending could actually be a further 1.5% of GDP higher by the early 2070s, and that's over 40 billion pounds in today's money.
I think what you were saying earlier, Ben, this is exactly an area where the government has lots of control here over the policy. The triple lock has this horrible ratchet effect where it kind of goes up over time in ways that the government didn't necessarily expect. But there are other things we could do on this policy.
Absolutely. And just before I answer that directly, I'd like to encourage anyone who's listening to this on a podcast app to get on YouTube to see Richard's fantastic mug making an appearance every so often. On the triple lock and alternatives to it, our colleagues in the recent big pensions review suggested an alternative, which is close to what happens in Australia, which you can basically call it a smoothed earnings lock instead, where you'd imagine that the state pension would go up in line with earnings instead, apart from in years where inflation is high, in which case you'd increase it with inflation to protect pensioners' incomes, but then you'd over time smooth it back so that it's at the same percentage of average earnings that you set out at the beginning as your target. And that way you protect pensioners, but you avoid this ratchet effect you see with the triple lock and the volatility that Richard was talking about as a sort of compromise option, which would be far better. And I also think the triple lock, it's expensive. These aren't small numbers we're talking about, but it's taken on almost like a symbolic role, I think. And it's a symbolic policy about particular intergenerational choices, but also I think taking action to improve what everyone recognize, or lots of people recognize as a flawed policy design, would sort of send a message about the government's serious about getting to grips with these issues. And that signal is as important sometimes as the policy finer details.
I think it's also just worth re-emphasising what you just said, which is that it's also, I think the debate ends up being about, well, if we scrap the triple lock, that can be, a disaster for pensioners. And actually, it's just the case that even if you want to protect pensioner incomes, there's just a better policy mechanism for doing that. And let's also dig around in another bit about pensions, which is the decline of defined benefit pension funds and what that means for the government. So DB pension funds are, very broadly speaking, the type where your employer tells you what you're going to get in your retirement and they put money into a fund, as opposed to a defined contribution scheme, which is what most of us have nowadays, where you put your own money into a pot and the pot accumulates. Well, this is the kind of question we would add on an IFS interview question. This is definitely a techie one. So look, maybe Ben, you can start with the high level, then I'll come to Richard. Ben, at the big picture, why is it an issue that we, over time, have less defined benefit pension funds in the UK?
So glad you asked, Helen, because it means I can put to use the 9 months I spent working as a pensions actuary before I joined the IFS. Defined benefit pension funds like to hold assets that are broadly matched to their liabilities. And so they like buying gilt government bonds, and in particular like buying inflation-linked government bonds, because when they run through their models, it shows that they're well protected against various shocks that might come along, and particularly they're viewed as safer. So if you've got some people in retirement, you don't want to be investing all your money in ultra risky schemes or assets, because you want to make sure that you can make the payouts that you're legally obliged to make. They've been a massive buyer of UK government bonds for a long time, but now those schemes are largely closed to new members. This sector's in decline, basically. As you say, most of us, including IFS employees, have a defined contribution pension. And so those schemes are just shrinking. They, as a result, are buying fewer government bonds, particularly long-dated government bonds, where they're a key buyer of those. And it just means that we spend a lot of time thinking about the supply of government debt, how much the government's borrowing, how many bonds it's issuing. But the demand for government debt is enormously important as well. And it means that if you're a government, issuing 100 billion of gilts now, it's a very different portfolio of buyers you'd face today than you would have faced 25 years ago. Maybe the marginal buyer now is a hedge fund, or it's a foreign investor, or it's someone who's a little bit less wedded to the UK, whether for regulatory or other reasons. And maybe they're a little bit more sensitive to price, and they're more willing to shop around. And that just makes it, if you're a government trying to get people to lend you money, it can become more expensive. And that, that's clearly a fiscal problem.
So Richard, how worried are you guys at the OBR about that potential increase in the cost of government borrowing coming through these, declining defined benefit pensions?
I mean, concerned enough to devote a whole section of a chapter of our fiscal risk report to the question. And Ben's right that traditionally pension funds have been very large buyers of government debt, and at some points in our history, including in the recent past, even up to the early 2000s, pension funds were accounting for sort of 2/3, 70% of overall ownership of gilts in the market. The shift from DB to DC schemes has already started to reduce pension fund demand for gilts, because DC schemes are much more interested in high-yielding assets and riskier assets than pension funds, and not just in the UK but around the world, because they're different. The nature of their liabilities is just different. And what we do in our fiscal risks report chapter is project forward. What is the decline of DB and the rise of DC likely to do for overall pension fund demand for debt? And what we find is that if you project forward the declining sort of DB schemes and rise of DC schemes, overall pension fund demand for debt falls from about 30% of GDP today to just over 10% by the middle of the century. And what you've got is rapidly falling defined benefit scheme demand for gilts, not being matched by a fairly slow increase in DC demand for gilts that reaches nowhere near what was the DB demand for gilts by the time you get to the sort of 2050s, 2060s. And so if government wants to continue selling debt in the same volumes that it does today, and we assume in these projections, by the way, that government debt is kind of held constant at 100% of GDP, it doesn't rise up to the 270 levels that our bottom-up projections would suggest. But even if government wanted to keep overall level of debt more or less constant as a share of the economy, it would need to attract other investors into the market who are almost by their very nature likely to be more price sensitive buyers than pension schemes. Because as Ben was saying, defined benefit pension schemes have got liabilities which are an almost perfect match for the asset that is in particular an index-linked gilt. So these instruments were sort of tailor-made for pension funds who've got sterling inflation-linked liabilities. If you're going into a market looking for buyers who are more what we call price elastic in economics, and people have actually got some savings that they want to put to use, increasingly overseas investors have been playing an active role in the UK gilt market. But we do think that if you're going to attract in those more price sensitive buyers, that is likely to push up gilt yields. That is likely to require the government to pay a higher interest rate on that debt in order to attract those additional buyers into the market. And we estimate that could increase the interest rate on government debt by up to 0.8 percentage points, some of which may already be reflected in the prices that you can see out there and the yields which governments are facing, which are at the 10-year point, somewhere around 4.5, 4.6. Some of that 0.8 might already be in there, but some of it might be yet to come as DB schemes wind down their holdings and the government needs to attract further investors into the market.
So there are definitely clearly risks around pensions. And let's quickly look at a couple of other risks in the report. So I'm going to turn to climate change. Now, some of the risks there are the kind of things that people will expect. There's money to be spent on mitigating climate change in the first place and adapting to warmer temperatures. But to me, what stands out like a sore thumb is the fact that actually a lot of the long-run impact of climate change to public finances is really expected to be the declines in revenues from fuel duties, which people at the IFS have been talking about long before the OBR was even created, actually, and pointing out this is definitely coming down the track. We know about it. We know we should expect it. And it genuinely amazes me that this government and previous governments haven't had a plan for how we deal with this risk. But Richard, rather than sort of digging into all the specific risks, I think by stepping back and thinking about how certain are we about these? Because there is part of the debate that says, well, hang on a minute, we could choose not to go to net zero. Do we even need to go to net zero? Do we need to bear these costs? So just like how confident are we that there is a cost of net zero that we have to bear, or how big is the risk there?
Yeah, you're right. And it's usual in these kind of long-term sustainability reports that there's lots of focus on the spending side because it's reasonably certain to project, what an aging population will do to the cost of pension spending going forward, because how many pensioners there are going to be and you vaguely understand the indexation rules. These reports tend to focus a bit less on the revenue side because oftentimes government don't think about the sustainability of their revenues. But one of the benefits of taking a kind of comprehensive look at questions like climate change and their fiscal implications is that you do pick up, sometimes these unexpected findings. And you're right. That when we did our projections about what if you were to put a fiscal price tag on getting to net zero by 2050, where do the costs show up in the public finances? Only about a third of them are the investment costs, the spending costs of trying to get there. That is investing in renewable energy, switching over government buses, government transport to renewable sources, switching over government office buildings. And also helping households heat their homes from renewable sources rather than fossil fuels. But actually 2/3 of what we estimate as being the overall cost of net zero comes from the loss of tens of billions of pounds worth of revenue, mostly in the form of fuel duty on petrol-driven and diesel-driven cars. And I should say, that trend is also looking reasonably certain. And because we don't have to forecast it, it's happening right now. You can see it happening on the streets of Britain all over the country. About 5% of cars currently on the road are already fully electric. About 25% of all new purchases of vehicles are fully electric cars, meaning that they use no petrol on the roads. And that means that those cars are not going to be paying any fuel duty. All of their energy is going to come from electricity. And even in our medium-term forecast, our 5-year forecast, if you look back in the one that we did in March of this year, that was the first time we ever did in one of our 5-year forecasts a forecast of fuel duty which showed revenues actually falling in cash terms in the final 2 years of the forecast, and that assumes that the government implements its seldom implemented indexation of fuel duty rates over the medium term. So even in the near term, you can see the revenue that government currently collects from petrol duty falling. That's partly because government is pushing ahead the net zero transition, but it's also because electric vehicles are just looking increasingly cheaper relative to petrol-driven cars, especially when you take into account the maintenance costs. So these things can happen just by virtue of private decisions being made by private individuals about which cars to purchase, and kind of independent of what government's net zero policies happen to be.
Okay, so let's quickly touch on the final risk that was the deep dive in the OBR report, because I know that Richard and Ben are very keen on doing this one, although it's a bit techie. So there's a set of discussions around the public sector balance sheet, and in particular, the potential risks associated with the fact that the government is doing more financial transactions. So maybe you can very briefly, Richard, tell us what that's about. And from where I was sitting, it looked like the least scary of the three that you've had a deep dive into. Is that fair?
I think that's probably fair. And as we said at the start, the government's now taking a wider view of the balance sheet when it's setting its fiscal targets. It's targeting this thing called net financial liabilities, which takes into account a wide array of financial assets and liabilities than traditional measures of net debt. That does open up some opportunities that come from a government being able to borrow to offer things like loans and make equity investments in businesses, in renewable energy schemes, in housing developments. But it also comes risks come with those investments from the fact that you're probably investing in schemes that the private sector didn't want to, and because either the returns were too low or the risks were too high. So governments are taking risks in these sorts of areas, and quite possibly bigger risks than the private sector was willing to take on, by virtue of the fact that people are coming to government for investment rather than getting them from a bank or from a private investor. And there are institutions who have been set up to make these investments. They're known in the trade as puffins, public financial institutions, and they are kind of closely watched and regulated by the Treasury to make sure that they're taking kind of reasonable risks and delivering reasonable returns to governments. But one of the things you've got to make sure you do from the point of view of valuing these loans and investments, and from our point of view of forecasting these loans and investments, is that if you do think that there's a likelihood of non-repayment on some of these loans, that you kind of reflect that likelihood upfront, and then you're not kind of living in denial when estimating sort of asset value of some of these things like loans, because we know from things like student loans and from other business loans that the government's offered that it's not the right assumption to assume 100% repayment of a loan that government's making to a business or to an energy scheme. In some cases, it's prudent to assume write-downs of 30, 40, sometimes 50% on the face value of that loan, because there is just an expectation that not the whole thing is not going to be repaid.
You got any upside risks, Ben, looking at these puffins or these financial transactions? Is there anything optimistic we can say here?
One optimistic thing, if you're a government overly obsessed with the fine print of your fiscal rules, is that I thought it was interesting in the scenarios presented in the OBR report. Some of the negative shocks that the OBR looked at, things like a shock to equity prices. So if you've got the local government pension scheme holds lots of equities, for example, or an increase in the discount rate, which can affect the liabilities held by those pension schemes, they push up per snuffle public sector net financial liabilities, but they actually can change the trajectory such that the fiscal rule, which requires it to be falling in 5 years' time, can actually be made easier. So we've got more debt, but then it's decreasing faster in the final year, thereby making the fiscal rule easy to meet, which is just a sort of peculiarity of how we've operationalized that debt rule. But I suppose if you were buried in the Treasury spreadsheets in the run to a fiscal event, that might be some optimistic.
Yeah. Of course, not advocating here gaming fiscal rules. We should wrap up soon. Before we do, I want to touch on sort of two big picture questions. And the first is to think back kind of historically about, had we had an OBR in the 60s and 70s, and we didn't, but had we had, what would they have been projecting? Does the long term always look scary, or actually are things particularly challenging today? What do you think, Richard?
I think sort of thinking about that question, if you think back to the 1960s and 70s, I mean, one thing you realize is that 50 years isn't that long term, because if you think yourself back into the position of people who were in the middle of the last century, well, if you looked for most of the second half of the 20th century, the dependency ratios, the ratio of people in retirement to those in working age, was pretty much flat for the whole second half of the 20th century, and into the early 21st century at around 50%. And I suspect if you asked them what they were worried about in terms of demographics during that period, I suspect they would have been more worried about overpopulation and too high a fertility rate than the opposite. There were lots of films in the 1970s which are all about there being too many people and what are we going to do with there being too many people on the planet, and too many mouths to feed. I think they would now be surprised, probably if you were to transport them into the present day, by how much the fertility rate has fallen and how much the demographic challenges have switched the other way, which is that you've got a shrinking cohort of young people, a shrinking number of people of working age, and a growing number of people with a much longer life expectancy than they would have predicted during that period. I think also when you look at actually what was going on with the public finances over that period, throughout that period, from the 1940s all the way through to the end of the last century, debt was falling year on year from over 250% of GDP in the aftermath of the Second World War, just highlighting how expensive wars are when governments have to fight them. It had fallen below 50% of GDP by the mid 2070s. So I suspect they would have taken a falling debt to GDP ratio sort of for granted and not really been thinking about what are the prospects of it going back up dramatically in future. But I guess another thing to say just about the nature of fiscal policy making in the middle of the last century was that it was remarkable how short-termist it really was. The first book I read as soon as I got a job in the Treasury 25 years ago was a book called Edmund Dell's The Chancellors, which was published back in 1996. And it was just an account of what was going on in the Treasury from 1945 until the end of the century. The middle of the 20th century was an era of high Keynesianism, a complete preoccupation with the UK's balance of payments from year to year, but almost month to month, and an obsession with preserving enough foreign currency reserves to keep the sterling pegged to the dollar. The government was only doing annual economic and budgetary forecasts. It didn't have any 5-year, let alone 50-year projections. And so my suspicion is that they were focusing an awful lot on, how do you manage the UK macroeconomy through the next 12 to 24 months, and not very much looking at, what are the prospects for debt rising in the future if we look, 5 years ahead, let alone 50 years ahead.
So in some ways, we're clearly in better shape now because we have an OBR and we are looking forward lots of years, and we do have further ahead forecasts. But as I started at the top with, we still seem to have this obsession where our debates also seem to be very focused on the next fiscal event and not really taking seriously sometimes some of these risks and what we might need to do now to tackle them. So, maybe I'll start with you, Ben. What big picture, what do we need to do to make these risks, I guess, more salient and actually start doing things about them?
I suspect that the one thing that will make us do something about them would be a proper crisis. I think we're very good at putting things off until we can't put it off anymore. So it's hard. The world is hard. Governing is hard. There are all sorts of pressures. There's all sorts of immediate demands on government. It's very hard to look up and look ahead to these things. But one of the things that comes out, for example, in the OBR's analysis of climate change is sometimes acting sooner can be cheaper than waiting and acting later. So, if we'd got a grip on some of the issues around road pricing and replacing fuel duty revenues, for example, earlier on, maybe you'd be better placed rather than try to deal with it all in one go at the end. Though maybe the ULEZ experience in London and the backlash undermines that argument somewhat. But in fairness to the Treasury, doing things like putting inheritance tax on defined contribution pension pots last year, I think it was, is dealing with the problem fairly early before it becomes a major problem in, say, 10 years' time, 20 years' time. So there's a little bit of that, but I'd like to see more getting on the front foot against things rather than waiting until, it's cripplingly bad before we do something about it.
Yeah, I guess, Richard, just before we draw to a close, if you had advice to policymakers, what would you love to see policymakers doing about these risks?
One thing we're not allowed to do is give them advice on specific policy measures, but I really echo Ben's point that a sort of stitch in time really saves nine in fiscal policymaking in terms of getting ahead of risks and pressures to the public finances. And just another example of that is, with the rise that we've seen in inactivity in the wake of the pandemic, people falling out of the labor force due to ill health. In a previous risk report, we looked at just the economic and fiscal costs of rising inactivity, especially amongst young people. And it really is very high if people fall out of the labor market early in their lives. and they don't work, you're facing a sort of triple fiscal cost because they oftentimes end up on benefits. So you're paying them out of work benefits. They're obviously not working and not paying tax. So you're not getting tax revenues from them working. And they also tend to be more ill for more of their lives and more seriously ill for much of their lives. And so you end up also having to pay to provide them with healthcare. The flip side of that is that if you can find ways of getting people who are currently out of work for health reasons back into labor force, you get a sort of triple fiscal dividend, which can be worth percentage points of GDP in terms of lower borrowing once you do these kind of longer term projections and look out 50 years. And so there can be big fiscal dividends from acting early and acting in a preventative way to stop these things, from adding to the economic costs and also fiscal costs to government.
Great. So we should draw this kind of discussion to an end, even though we've only sort of touched on some of the big long list of fiscal risks. I really would recommend that people go and look at the Fiscal Risks Register, especially if you are a journalist or a policymaker. I think it is definitely worth a skim. I think reflecting on this discussion, I don't think the OBR are being sensationalist when they say that the risks are daunting. If you look at the current health of our public finances, I think it's fair to say they're not in peak fitness. We have high debt historically and internationally. We spend a lot on debt interest. And dealing with those issues is much harder because we have such low growth. And on top of that, we are exposed to a pretty serious set of risks. In painting with a very broad brush, we've heard about risks where spending could run far ahead of taxes if we don't see policy action. Other shocks could come along. We need to worry that debt could ratchet up each time we get a shock, or that higher debt may make us less able to respond to shocks in the future. And although we're not currently in a situation where no one will lend to the UK government, we are in a situation where asking people to lend to us could get more expensive. And that matters for all of us because that would mean more of our tax revenues going to service the debt rather than pay for the other things we might like in public services. We talked about how recent governments have had plans to have debt falling, but those plans, when the time comes, haven't been delivered. They've been pushed back, and that comes with a cost. So in my mind, we have to find a way to do better. And I very much agree with what we've heard today with Richard and Ben, that we should be talking now about how to deal with some of these risks and not simply waiting for them to hit. When I asked Richard and Ben what keeps them awake at night, I think what keeps me awake, other than two small children, is actually just the number of risks on that register. I think it's unlikely that they'll all materialise, but I think it's also foolish to think that none of them will materialise. I think, as we talked about today, some of them I'm not even sure I'd call risks, in the sense that the probability of them happening is close to 1. And I think fuel duty really is a great example here. We've been saying for decades this is an issue coming down the track. We know that fuel duty revenues will decline, and yet no government has yet had a plan for how to replace that. And that there are things we could do. We could, for example, start doing road pricing or start taxing electric vehicles. So that's definitely a risk where we need to do something. The other thing I worry about is state of the public debate. I think if we want governments to take these things seriously and to be more long-term, we have to take them seriously, and we have to ask different questions to our government. There really is more to talk about than just the headroom. But let me sort of end optimistically, because I think the danger of saying we need to talk about these challenges is that it sounds like an all doom and gloom kind of conversation, that things are bad now and they're going to get worse. But actually, I think we could have a very optimistic conversation about the country we want to live in, what we can invest in now to make a brighter future, or how we could do lots of reforms, whether it's to tax or road pricing or pension triple locks or disability benefits or health services or whatever else happens to be, to make those better policies and make us in a better shape. So despite this daunting list of risks that we started to flag today, I'm actually still pretty optimistic, because I think there are things we could do with policy today that will make things better. But on that, let me say a huge thank you to Richard for joining us. Thank you to Ben, and thank you to all of you for joining us and for listening in to the IFS Zooms In. If you enjoyed this episode, please do subscribe in your podcast app and share it with anyone else you think might be interested. And if you'd like to support our work, you can become a member of the IFS for as little as £10 a month. Just check the link in the episode description. Thanks again for listening, and we'll see you next time.